Hey, how's it going, everybody? Welcome to Finance with Avery. It's tax season, and for some people, they're looking forward to it, looking forward to getting some money back. Some people are dreading it, not looking forward to possibly paying money to the IRS. But overall, people in general want to receive some money back because who doesn't want a nice refund to put towards savings, paying down debt, treating yourself, investing, something fun, whatever. But the key to maximizing that return isn't about hoping for the best. It's about being proactive with your finances and knowing what strategies work. The IRS will officially start accepting tax returns on Monday, January 27th, 2025. Now let's get into it to see how you can take advantage of some straightforward strategies that can really make a difference. Now, the first thing I want to talk about is maximizing deductions. Take advantage of the standard deduction or itemized. So deductions are one of the most straightforward ways to reduce your taxable income, which in turn lowers the amount of tax you owe. If you're not familiar, the standard deduction is an amount the IRS lets you deduct from your income before it calculates how much tax you owe. The standard deduction amounts for 2024 are the following: $29,200 for married filing jointly or qualifying surviving spouse, $21,900 for head of household, or $14,600 for single filers or married filing separately. Now the catch is you only get to take the standard deduction or itemize your deductions. You can't mix and match both of them. Itemizing means you add up specific expenses like mortgage interest, state and local taxes, charitable contributions, medical bills, and so forth and so forth. And if your total deductions are higher than the standard amount, you can go that route. Now, when you're filing your taxes, if you file your taxes yourself, you can go to pretty much the finish line of both routes of this to see which form of deductions is going to get you the biggest return. Typically, a lot of the tax software out there is going to kind of guide you in a certain way. Once they figure out your income and deductions, they'll say pretty much, hey, the better route for you is going to be the standard deduction, or the better route for you is the itemized deductions. Would you like to continue with this or that or something like that? Typically, a lot of the tax software out there knows which route is going to give you more money as you start putting in info. Most people go with the standard route because it's easier. But if your deductible expenses like that mortgage, medical bills, charitable donations, all that, if all that adds up to a sizable amount, then itemizing could save you more. The goal here is to reduce your taxable income as much as possible so you pay less in taxes, because your taxable income is pretty much set. Where your income is from your employer or your side jobs, side hustles, whatnot, however you get your income in, it could change throughout the year. But once it's all tallied up, for that 2024, that taxable income is set. You've got paid the money in 2024 that you got paid in 2024. And now your deductions that happen in 2024, most people don't keep track of those, but you keep track of your, income because you're getting that in, you're divvying it up to bills and, spending and investing, hopefully, saving, hopefully, and all that. But your deductions, they just happen. The medical bills happen, the mortgage happens, charitable donations, they happen. And so if you're not keeping track of those, this is the time right now to gather up those receipts, search that email, look on your computer, you got to file for something, check out, you got your statements that come in the mail. Gather that information, look through there while you're doing your taxes and add that up in the software that you're doing. Or if you get someone else to do your taxes, this is a good time to get all that information together. So you want to be organized when you go and get your taxes filed. So have all the information, have your deductions, take it with you. Don't just go get your taxes done and just say, I'll just go with the standard amount, quickest way, get in and out. Set aside some time, make sure you have time, and say, okay, I have some deductions, but I want to see which route is going to be better for me. Here are my deductions. And then the person doing your taxes, the tax expert, they know about this. They know about the itemizing and standard, and they're not going to say, blow it off. Now, if you go to somewhere and they just completely blow you off your itemizations of your deductions, when you bring it to them, you might want to go somewhere else, go to somebody else who's going to take you more serious and be there for you in that moment of doing your taxes for sure. The goal here with itemizing your expenses is to reduce your taxable income as much as possible so you pay less in taxes. So yeah, gathering up all those receipts, mortgage interest, medical expenses, charitable donations, all of that, have that ready for yourself if you're doing your taxes, or for someone else if you're getting somebody else to do your taxes. For your 2025 taxes, you can go ahead and start thinking about those for when you're filing in 2026. Your 2025 taxes, you can think about charitable donations or paying off your medical bills during that year. Different things like that to possibly lower your taxable income to push you into that itemization of deductions instead of just taking that standard deduction. So right now we're kind of past that amount to be able to do anything with that, but we are still in a moment where your knowledge is power and knowing that you have the option possibly to itemize to get that better deduction, or possibly standard deduction is better. You want to try both, see which route works for you the best that's going to give you the bigger return. That is the first section right there, is maximizing your deductions. Now, next section I want to talk to you about is contributing to your retirement accounts, the IRA, individual retirement account, 401k before the deadline. And so this is actually something that can still be worked on here in 2025. Now, I know that last section, income, deductions, everything that's happened for 2024 has already happened in that realm. Can't really do much about that, but you can think about it in the future and definitely apply it to your taxes, right now, what you're doing for 2024. But this section right here, you can still possibly change some things in this section. So what is this? Contributing to retirement accounts. One of the easiest ways to cut down your taxable income is to put money into a retirement account like a 401k or traditional IRA. Now, with these types of retirement accounts, contributions to these accounts are tax deductible, meaning you can lower your taxable income right now and save for the future at the same time. Now, if you're familiar with my channel and when I talk about investing in ETFs and retirement, you've likely heard me talk about a Roth IRA. I'm a big fan of the Roth IRA. However, in this moment right here, in this realm, when I'm talking about with these taxes, this won't help you with the Roth IRA. The contributions to a Roth IRA are already taxed. But the great thing about a Roth IRA is that all your gains and everything when you retire and take out your money from the Roth IRA, all that is not taxed. So yeah, definitely, I'm a big fan of Roth IRA, but I'm not going to talk too much about it right here because I don't want to confuse people with this section of saying like what you can contribute to. So let's zone in on those other retirement accounts. I'm going to put it off on the side and just mention like Roth IRAs are awesome. That's all I'm going to say. Now, contributions to a traditional IRA or 401k are tax deductible. Now, for the traditional IRA, the contribution maximum amount is $7,000 or $8,000 if you're age 50 or older. So for both of those contribution limits for the traditional IRA, that's an increase of $500 from 2023, where it was at $6,500 and $7,500. Now $7,000 for under 50 and $8,000 for 50 and older. So for both of those contribution limits for the traditional IRA, that's an increase of $500 from 2023, where it was at $6,500 and $7,500. Now $7,000 for under 50 and $8,000 for 50 and older. And contributions to this account can be made until April 15th, 2025 for the 2024 tax year. Yes, you heard that right. You can still contribute to this account right here, the traditional IRA, and have that affect your 2024 taxes. So if you can, try to hit that maximum amount and make it to where those contributions go towards your 2024 tax year. The investing platforms typically ask, where do you want this applied? Like when you deposit money into that account, the traditional IRA, to put towards investing, asking you to pick which year you want to apply to. You don't have to meet your max to, start contributing for the next tax year. So if you just put $2,000-$3,000 in there for 2024 and you want to say, okay, that's it for 2024, I just want this to go towards the max contribution for 2025, you can. So yes, you can make that maximum amount of contributions to that traditional IRA up until April 15th, 2025 for the 2024 tax year. Now, a 401k is typically associated with your employer. If you have a 401k, something like that with your employer, you have money just coming from your check automatically, just going into that 401k. That's the way to do it. Just get used to it. Don't, even depend on yourself to do it. Just have them take out the certain amount, especially if your employer does any kind of matching. If your employer matches, 100% up to 2% and then 50% after that, or 100% up to 4% and nothing after that, whatever. Definitely contribute as much that you're going to get at least the match from your employer, because that match from your employer is basically just free money. Now for 401ks, the contribution limit for those for 2024 taxes are $23,000, up from $22,500 from the previous year. So for 2024, typically the 401k part is pretty much done for you because, you've already passed 2024 as far as like your income from your employer. You've got paid all you got paid for 2024. You contributed all you're going to be able to contribute for the 401k through your employer for 2024. But that's just something to keep in mind because that money that you contributed to your 401k is tax deductible. So retirement contributions can lower your taxable income. And if you're able to max them out, you can move into a lower tax bracket, which means less tax owed. And a tip for this one, even if you can't max out the limits, any contribution helps. And if your employer offers that match, definitely contribute enough to take advantage of it. I just want to mention that tip again. And make sure you contribute before the tax filing deadline of April 15th, 2025 for the IRA contributions. You still have time to possibly move yourself down to a lower tax bracket. Wouldn't you hate if you found out that if you would have contributed $100 or $1,000 more or something like that to your IRA, traditional IRA, and could have lowered yourself and could have put yourself in a lower tax bracket, but you didn't do it? Wouldn't that would get me? I don't know if I can forgive myself. I would just look in the mirror and just point at myself and be like, Avery, you could have lowered you really? What did you do with that $100, that $1,000? You could have, yeah. But anyways, so definitely just try to do it if you could do it. Any contribution helps, even if you can't maximize your contribution, put as much as you can into that traditional IRA. Not only could they help you with your taxes, that's money going towards your future, towards your retirement. That's going to grow, so put it in the market, let it get to work for you, put that money to work for you. Yes. All right, let's move on to the next section. Next section is claiming all available tax credits, especially the child tax credit and earned income tax credit, if applicable. Let me get into the details of these. Now, tax credits are worth their weight in gold because they directly reduce the amount of tax you owe, dollar for dollar. The two big ones that can really bump up your refund are the child tax credit, shortened to CTC, and the earned income tax credit, shortened to EITC. Now, the child tax credit for 2024, parents can claim $2,000 per child under age 17. Up to $1,600 of this credit is refundable, which means even if you don't owe any tax, you can still get that portion of the credit as a refund. Now, the earned income tax credit. This is separate from the child tax credit. The earned income tax credit, EITC, this is a refundable credit designed for low and moderate income earners. Depending on your income, filing status, and number of children, the credit can be as high as $7,430 for families with 3 or more children, or $600 for those without kids. Now, both of these are credits, not deductions, so they directly lower your tax bill. If you have kids, the child tax credit is a huge benefit. And if you're on the lower end of income spectrum, that earned income tax credit could be a game changer. If you don't owe enough taxes, both of these credits are refundable, meaning you could get the credit as a refund. So eligibility for the EITC, the earned income tax credit. Now, this is one I know myself personally, I'm not eligible for it. So I don't know when I have been. And that's not me trying to say I make a lot of money. I'm not rich or anything, but I'm above the threshold to be able to earn this credit. And believe me, when I do my taxes, I'm like, man, it'd be nice to have that credit. But of course, that's a whole different thing about, the income, blah, 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 all that kind of stuff. But I do see it there and I'm like, in the moment, I'm thinking that would be nice. But hey, it's definitely helpful for those who can get it. So if you qualify, definitely get the earned income tax credit. So to qualify for the earned income tax credit, your income must be below certain thresholds, which depend on your filing status and number of children. Definitely when you're filing your taxes, if you do it yourself, see if you're eligible for the earned income tax credit, depending on your filing status and income and all that. If you get someone else to do your taxes, definitely, if they don't mention it yourself. Say, hey, am I eligible for the earned income tax credit? And it may be a quick, oh no, look at this, you make way too much money, or this, blah, blah, blah. And that's fine, but then you know for sure that it was attempted. You want to know if you were eligible for this or not, why you didn't get it, and if you do get it, you want to know that you're getting it, of course. So the earned income tax credit is one of those things, once you're not eligible for it, chances are you're probably not going to be eligible for it ever again, because you want to, of course, keep progressing in your career, your income, things like that. So it's just one of those things, you may be eligible for it now, but you might not be eligible for it next year or the year after or something like that. Who knows? If you stay, you may have another kids and maybe you may, have more income but have more kids, and somehow that balance works out where you'll still be eligible for another year or two or so forth. How knows? And also, there is a tool on the IRS's website, the EITC Assistant, that you can use to see if you're eligible and check your income thresholds. So even before filing your taxes yourself or taking your taxes somewhere to be filed, you can do this yourself and check out to see if you're eligible for that earned income tax credit. Now, if you have kids, definitely make sure to claim the child tax credit and don't leave any money on the table. Some bonus tips here: review your withholdings and adjust if necessary. Adjusting your withholdings could help you avoid getting a big refund. Now, if you're constantly getting a big refund, it means you've overpaid throughout the year. If you're always facing a tax bill and having to pay, that means you probably underpaid. A balance that I like to reach basically is almost being flat, either barely having to pay anything or barely getting a big refund. Because you may be thinking like, don't you just want a big refund, Avery? What are you talking about? No, I don't want to overpay on my taxes and then just wait until next year to receive that money back, because I could put that money to work better myself than just letting the government hold it, without any kind of interest. They're not paying you interest on this tax refund they're giving you. Let me tell you that for sure. That all that money you overpay the government, they're not going to say any kind of thank you for that. Here's some interest on this and a little bonus for letting us hold that money, paying us extra throughout the last year. No. So me personally, no, I'd rather not overpay them and use my money to its full potential that I possibly can, whether that be wherever I need to apply that money, put that money. I'd rather do that myself. So no, but yeah, so overpaying throughout the year, it happens, definitely. And when you get that big refund, it's nice because it's just like, oh yeah, oh wow, I overpaid, or oh, I wasn't expecting this or something like that. But that's something you could think about for the next year. If you don't want to do that, or if you want to keep doing that, that's totally fine. If it works better for you to overpay throughout the year and then get that big refund the next year, then it works for you. That's totally fine. Now, that means just, keep your withholdings the same. Don't change them too much. If you want to do something different in that route, then you're going to need to adjust your withholdings to have your employer take out less taxes from your income. Now, if you're on the other side of this and you're always paying a lot in taxes, that means you're underpaying. That means you need to get more taxes taken out of your pay. You need to adjust your withholdings to have that done. So, go inside your employer portal or HR if they do it for you, however they do it. Typically, a lot of places you can do this yourself within the intranet of the, employer, whatever they got set up, and adjust your withholdings to either, have it where you're not paying as much or you're paying more, depending on how you want your tax bill outcome to be that next year. And IRS has another tool on their website, the withholding estimator, that you can use to check if your current withholding is on track. So if you've gotten big refunds in previous years, you can consider adjusting that on your W-4 so you have more take-home pay throughout the year, meaning you get more money on your check every 2 weeks or every month or whatnot. But then that next year when you're filing your taxes, you won't get that big refund, but you've been getting that money throughout the year. So you can adjust this however you see fit, however it works for you. On the IRS website, the withholding estimator, you see it there on the screen. You can go throughout, play with that, put in your income, your other information, and see what you need to put as your withholding to get that certain outcome that you're looking for with your taxes. So yes, that is the video right there on 3 major factors of maximizing your tax return. By understanding how deductions, credits, and retirement contributions and so forth can work for you, you could be in a great position to pay less in taxes or get a nice refund. Whether it's adjusting your withholding, contributing to your retirement, or claiming credits like the child tax credit and earned income tax credit. A few smart moves here and there could definitely add up to more money in your pocket. Hope you all enjoyed the video. Take care.